Ladies and gentlemen, good day and welcome to Suryoday Small Finance Bank Limited discussion on Q2 and H1 FY26 earnings conference call. As a reminder, all participant lines will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Shailesh Kanani from Centrum Broking. Thank you, and over to you, sir.
Thank you, Shravani. Good morning, everyone. Welcome to Suryoday Small Finance Bank Q2 and H1 FY26 earnings conference call. On behalf of Centrum Broking, I would like to thank the management of Suryoday for giving us this opportunity to host this call. Today, we have with us the entire top management team of Suryoday Small Finance Bank, represented by Mr. Bhaskar Babu, MD CEO, Mr. Hemant Shah, Executive Director, Mr. Kanishka Chaudhary, CFO, and Mr. Himadri Das, IR Head. I will hand over now to Mr. Bhaskar Babu for his opening remarks, and then we'll open the floor for the Q&A session. Over to you, sir.
Thanks, Shailesh. Good morning, everyone, and thank you for joining us for Suryoday Small Finance Bank Q2 and H1 FY26 earnings conference call. We sincerely appreciate your time and interest in the bank's performance. Our financial results and investor presentation are available on our website as well as on the stock exchanges, and I hope you had an opportunity to go through the same. Taking you through the bank's performance for Q2 and H1 of FY26. Our gross advances stood at rupees 11,124 crores as at September 30th, 2025, reflecting a year-on-year increase of 18.9% compared to rupees 9,360 crores last year. Disbursements excluding SCF during the half-year ended September 30th were rupees 3,973 crores, up 18.1% from 3,366 crores in the same period last year. As you are aware, the industry had been facing multiple headwinds in the inclusive finance that has moderated growth and put pressure on asset quality and profitability. There are green shoots visible in microfinance sector, and with improved collection efficiency. On the growth front, the bank's disbursements remained healthy across all segments, particularly in Vikas loans, wheels, and mortgage business. Notably, the Vikas loan disbursements stood at rupees 905 crores in Q2 of FY26, an increase of 111% on a year-on-year basis. This growth is on the back of the strategy that the bank embarked on a couple of years ago to move towards individual loans as against the JLG model. The mix within the inclusive finance model now stands at 70-30 in favor of Vikas loan. With the addition of new-to-bank Vikas loans, that's NTB-VL as a product offering, the mix is further expected to tilt in favor of Vikas loans. On the retail asset front, the bank continues to grow at a significantly higher pace, both in the commercial vehicle business as well as the mortgage businesses. The CV book has grown from rupees 1,047 crores in September 24 to rupees 1,564 crores in September 25, a growth of 49% year-on-year. Over the last 3 years, the bank has focused on building a retail franchise. The retail franchise in CV financing business will continue to be one of the mainstays, and we would be scaling up the commercial equipment financing business as well as used cars lending business. The mortgage book has grown from rupees 1,845 crores in September 2024 to rupees 2,555 crores in September 25, a growth of 39% year-on-year. The strategy has been to focus on select micro markets and grow deeper in these markets with focus on cash flow-based financing as against collateral-based financing. Our deposit base has expanded to rupees 11,991 crores, a 35.5% increase from rupees 8,851 crores in the previous year. The share of retail deposits now stands at 86% as of September 25 compared to 80.2% a year earlier. Our CASA ratio improved to 20.7% up from 17.9% as of September 24. The bank implemented guardrails early in November 24, and the current bucket collection efficiency on the IF portfolio sourced in the last 12 months has been at around 99.5%. During that period, our GNP ratio though increased to 5.9% as of September 30th, 2025, as compared to 2.9% in the same period last year. The bank, as part of the prudent risk management strategy, initiated covering eligible loans under the Credit Guarantee Scheme for Micro Units, that is CGFMU, since FY23. We are pleased to inform that the bank has successfully made its third claim in September 25 and has received 100% of the amount claimed of around rupees 313 crores. The bank continues to cover the entire eligible portfolio under the CGFMU scheme. The cover has helped the bank to protect the bank's capital during the volatile environment wherein the industry is facing significant asset quality issues. Moving to our financial performance, our total income decreased by 2.7% year-on-year from rupees 347 crores to rupees 338 crores. Our net interest income decreased by 13.9% year-on-year from 300 crores to rupees 258 crores, and our pre-provisioning operating profit decreased by 37.6% from rupees 127 crores to rupees 79 crores on a year-on-year basis. As of September 25, our cost of funds stood at 7.8% compared to 7.6% a year earlier. Our cost-to-income ratio for H1 FY26 was 72.9% as compared to 61.8% in the corresponding period last year. Our profit after tax decreased 33% year-on-year from rupees 45 crores to rupees 30 crores. We continue to maintain a strong capital adequacy of 23.4%, well above the regulatory requirement of 15%. Our bank's digital banking strategy has also played out with digitally sourced deposit crossing rupees 1,300 crores and constituting over 10% of the total deposits of our bank. This channel has helped the bank acquire over 80,000 retail fixed deposit customers, and we are confident that this will continue to be a significant growth engine for our bank. The digital channel is extremely scalable with incremental costs required to achieve higher scale being limited. Also, the customer acquisition cost is lower than the traditional channel. Our bank has also introduced various products in the digital channel, such as secured credit cards and digital MSME loans. Also, during the quarter gone by, the bank has partnered with Paytm and launched the credit line on UPI product. The product has already started seeing scale, with the bank having onboarded over 50,000 customers under the program till date. We believe products such as secured credit card and credit on UPI can be a real value addition for our banking customers. Our focus for H2 FY26 will be on deepening engagement with MSMEs, expanding secured lending and strengthening the Vikas loan franchise while simultaneously accelerating CASA growth through digital-led journeys and broadening our retail base with a sharper focus on granularity. We also want to leverage our smart banking outlet micro strategy to further enhance customer reach and engagement. In parallel, we remain committed to fortifying internal controls, nurturing mid-management leadership, and embedding customer-centric design across all our products and services. With improving repayment trends, disciplined credit process, and easing portfolio stress, the second half of FY26 is expected to mark the start of a steady recovery for us, setting the stage for stronger growth in FY27. Our customer base expanded to nearly 3.6 million as of September 25 compared to 3.2 million a year earlier, reflecting our continued focus on financial inclusion. Our mission is to serve our existing base, representing nearly 1% of the Indian households more deeply and meaningfully, becoming their comprehensive financial partner through initiatives anchored in trust, experience, and satisfaction. Thank you, and over to you, Shailesh.
Yeah, Shravani, you can open the floor for Q&A.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Sumil Shah from Paris Investment. Please go ahead.
Yeah, hi sir, good morning. So if we see our other income, it has gone down considerably from around 109 crores to 80 crores last quarter. So, and because of which our PAT has also reduced significantly. And it seems that it has not liked our performance. So, I mean, can we know what was the reason for such a drop in other income?
Correct. So there are two major drivers there. So one is, the PSLC income that we earn on selling the PSL certificates. Last quarter, we made about 32 crores of income, and this quarter we made around 10. and this is largely due to the seasonality, right? Most of the PSLC certificates get sold in Q1. The other is that, in our investment book, we had a one-time sale on which we had gains of 13 crores in Q1, and which is the reason why you see that drop in other income.
Okay. So going forward in the remaining 2 quarters also, PLC income will be equal to our current quarter income?
So PSL income will be quite muted in Q3. We are likely to see some opportunity again in Q4, which will be possibly similar to the 10 crores that we have made this time. The good part is in both the quarters, our pricing remained fairly firm at 2.8%. So to that extent, we can see some uptick in Q4.
Okay. And so on the ROA guidance, I mean, even in this quarter, we have reiterated that we can do around 1.5 to 1.6 ROA for this current year. But if we see first half, I mean, it's hardly 65 crores. So for the remaining half, we have to do almost 3 times the profit of first half. So is it possible? How confident are we to achieve ROA of 1.5 to 1.6?
Yeah, at this particular point in time, we are targeting to have an ROE of, at least around 1.2% as things stand today from here, and then improve with some incremental efforts on our side, more in terms of recovery from our recent NPA pool, which is likely to give the uptick. So as things stand today, 1.2% is around what we are targeting, which will translate to a ROE of anywhere between 8 to 9%.
So just to clarify, what you have repeated is that whatever we gave as a guidance last time, we haven't really changed that because we're just mentioning what was given as a guidance, and currently we are stating where we are.
Okay, so for this financial year, we can do about 1.2 ROA for the full year.
Yes, that's right.
Okay. And so, on the GNPA and NNPA front, since we have received our claim this quarter, I mean last quarter, and we are targeting about 5 gross and 3 net. So, is it possible that we can achieve this 5 and 3 by end of this year? Because I think now there would not be any CGFMU claims for this year, right?
Yeah, again to repeat, this is what we said 5 and 3. Currently, we have made our claim. The question was in terms of whether claiming in Q2 or Q3. We could have kind of portion claimed it in Q3, but however, we chose strategically to make a claim in Q2 as the amount was large and we wanted to make sure that our systems and processes are completely compliant. So we did choose to do it in Q2. So at this point of time, as the norms stand, there will be no more claims possible in this financial year unless there is any change in terms of the CGFM norms. As you said that yes, it will not be, but however, our net NPA, including eligible claims, will continue to be closer to 0%.
Okay. And so, may I know, what was the collection efficiency for the month of October?
It's around 98.5 in terms of the overall portfolio, 99.5% in terms of the last 12 months originated portfolio, which currently comprises approximately around 60% of the 60% of our portfolio.
So X bucket was around 98.5 for October?
Yes, correct. 98.5.
But the point that is being highlighted is that the book that has been built in the last 12 months, the X bucket collection efficiency for that book is 99.5.
Also equally good apart from the current is that I think 30 plus on that portfolio which was built in the last 12 months is just a little shade less than 2%.
Sorry, I didn't get the answer.
There are 2 things. One is the current bucket efficiency, which is say 99.5, but if the 0.5 resolution rate is very low, technically that could mean that approximately 4 to 5% of the portfolio also would be in 30 plus. So currently what we see as a 30 plus portfolio in this 12 months originated portfolio is a shade less than 2%.
Okay.
1.5.
Understood. Okay. And my final question, okay. And so we have mentioned, in our presentation that we are going to raise equity of about around 1,000 crores. So, we wanted to know whether this will be below book value. Are we considering it in this financial year to raise 1,000 crores?
This is an enabling provision. So we kind of already guided that we are comfortable with a capital adequacy of approximately 20%, little higher than the regulatory requirement of 15. So to that extent, it is an enabling provision, and it is not that we have any plan immediately to raise. And hence, the question in terms of not deciding on the price is not relevant at this point of time.
Okay. But sir, anything below book value won't be the right, as a shareholder, I mean, nobody will like if we raise funds below the book value at least.
We haven't even thought about the pricing for sure. So to that extent, yes, your input is well taken. Thank you.
Thank you. That's it from my side. Thank you.
Thank you.
Thank you.
Thank you. The next question is from the line of Deepak from Sapphire Capital. Please go ahead.
Yeah, am I audible, sir?
Yes, please.
Yeah, thank you very much, sir, for this opportunity. So just first up, I think we are still maintaining advances growth of 30-35%, right? So second half, I mean, the first half, the growth till now has been in the range of 19-20%, right? So ideally, your second half growth will accelerate. That's what we expect now, given we are maintaining 30-35% advances growth.
Currently, yes, we are looking at 30. Two things. One, the write-off of 400 crores which we did last year was also in the books as NPA last year at the same point of time. So to that extent, this is a little shade lesser in terms of a comparison. We were removed on both the sides, probably a little higher than around 21-22%. So usually the Q3 and Q4 are expected to be pretty good quarters for inclusive finance. However, the fact was that it wasn't really so last year because of the stress. What we are seeing currently is a slide in the acceleration of in the accrual of GNPA portfolio. It used to be hovering at around 70-75 crores at the beginning of the year to less than 35 crores at this point of time as we see. In terms of the new overdues that are getting added, it shade less than 20 crores. So mathematically speaking, that is what will translate at max to a GNPA accrual towards the end of Q4, probably starting from Jan and Feb. So given that overall there has been green shoots, and specifically in our VL portfolio, there is substantially improved collections in the overall, specifically in the terms of the 12-month portfolio. And we also mentioned elsewhere that our pre-approved portfolios, our approval limits for inclusive finance stands closer to around 8,000 crores, around approximately 1 million customers, which also includes inactive customers. So our effort is in terms of making that process quite smooth, in terms of doing all the work at the back end and making it comfortable with the customer. At this point of time, our inclusive finance is completely digital with no pen on paper at all. So currently, the run rate in inclusive finance has moved to around approximately 425 crores. So there is a marginal dip in the month of October. Fairly confident to get it back to closer to 450 to 500 crores consistently for the next 5 months.
Okay. So ideally, your disbursement will also improve because I think in second quarter it was in the range of 2,400 odd crores. So you expect disbursement in third quarter and fourth quarter to improve substantially, right?
Yes, please. That's what we are focusing on right now. I think the heavy load of past due collections has been significantly managed. Our focus right now for second half of the year is originating new business.
Okay, understood. And how should one look at on the cost of fund part? I mean, it was 7.8%, right now. So how should one look at cost of fund?
So I think, if you look at Q2 standalone, it has been quite encouraging because we have been able to reduce our cost of funds across both fixed deposits and SA. In SA, at the lowest bucket, we have been able to reduce our rates by about 1%. In the fixed deposits in both the 5-year and 3-year bucket, we have been able to reduce our rates by about anywhere between 50 to 75 paise. So with that in place, our cost of funds on deposits is likely to be lower by anywhere around 20-25 paise for the second half of the year.
Okay. So that will directly add to your NIMs?
Yes, please. That's right.
Unless there's a repo cut, then the transmission will happen because all our floating loans are directly linked to repo, not to any internal benchmark rates. So to the extent if there is any, it may kind of nullify it on a temporary basis.
Okay. So your yield reduction will kind of nullify your cost of fund reduction, and your NIMs you look to maintain, or there might be marginal improvement also.
Yeah, there will be marginal improvement as we see it from here on.
Okay, fair enough. And in terms of your ROA and ROE, you mentioned ROA of 1.2% and ROE of 8 to 9% that we are targeting for this year, right?
Correct.
Okay. So even at a ROA of 1.2, I mean, you would have to reach a bottom line of around 190 to 200 crores for this year.
Yes.
Given we have done 65 crores in the first half,
Right.
so that is left
Yes.
with maybe what, 130, 35 crores. So 65 crores per
Right.
quarter for remaining 2 quarters. So what will drive the earning in the second half? I mean, will it be NIMs or will it be your other income? You mentioned PSLC will be muted in the third quarter. So just wanted to understand, currently we're at 30-35 trajectory, so what will drive the movement from 30-35 to maybe what, 60-65 crores per quarter? Yeah.
So
That would be
right
helpful.
now our focus is on increasing our paying book, right? So if you look at our MFI business, our paying book is somewhere around 4,300 crores, and we would want to increase it to anywhere between 400-700 to 4,800 crores, right? And that's the book where I'm earning on an average around 25.5 to 26%. So that's one of the drivers. The second, which will be key for us, is to be able to, focus on the recovery on our recent NPA pool. Now that we have been able to stabilize our flow forwards to, somewhere around 35 crores a month, our significant focus will be on being able to recover in the recent NPAs of this year.
Okay. So drivers, one is the recovery of NPA pool. So ideally, you would expect a much lower credit cost, right, in the second half?
Yes, from where we stand today, yes, we are expecting that. Yes.
Okay. So
Just to clarify, the amount of when we get a recovery of the CGFMU covered portfolio, 73% will be returned back to the fund. So to the extent net we will retain is around 24. We are kind of staying focused in terms of ensuring at least we collect 20 to 25% of that money which you have claimed. So to the extent our share may be 25, but overall there will be a collection. 73% of that will get returned back to CGFMU.
Understood. And just the last point, I did not, understand what increasing paying book, what exactly we mean. Sorry for my ignorance. So I'm not able to understand what you mentioned on the increasing paying book.
Yeah. Hi. So, see, every month we are adding approx 300 crores of our advances, paying book approx. So next 6 months, even if I add the run rate of 300 crore, I would add approx 1800 crore in my advances. So my growth from 11,000, it should be nearly 13,000 crore advances. Now that 1800 crore, if I average it out, broadly 1000 crore, it will give me for my next 6 months revenue. So this 1000 crore into spread of 17% yield minus your cost of fund of 8%, which is 9%. So it should give me 100 crore of extra operating profit for next 6 months. 50 crore of extra operating, 100 crore for a full year, 50 crore for a half year. So 50 crore, that is what KC was trying to say. If my growth in advances, what we are currently having, if we continue that, we will be having 50 crores of additional income without any substantial increase in cost. And along with that, the credit cost for the half year, whatever we have spent, we are expecting it to be much lower. So advances growth of 50 crores and much lesser credit cost should give me whatever you are saying, incremental 100 odd crores.
Understood. And do we have excess liquidity also? How much do we have? Because we got some 350 crores, 313 crores, right? So do we maintain any excess liquidity which we look to deploy maybe?
Yeah, so we have excess liquidity of about 1,000 odd crores right now. But over the period of this quarter, it will come down as we, basically disburse the new business. So we will be looking to reduce our excess liquidity over time in this particular quarter.
Okay. So that will also will help reduce the drag, right?
Yes.
Okay. Fair point. I got this, and all the best to you. That's it from my side. Thank you so much.
Yeah. Thank you.
Thank you. The next question is from the line of Arvid Ratan from Capital Land. Please go ahead.
Yeah, hi. I have a couple of questions on the presentation. Firstly, on slide 8, if I look at the effective yield on advances, it's come down with 320 basis points to about 16.5%. Now, I understand part of that is because of the excess liquidity we are holding, the deposits growing faster than advances. and the fact that our GNPAs have, or the non-interest yielding portion of the book has increased. But just trying to understand how much of this 320 bips reversal, 320 bips reduction in yield is likely to be reversed as we sort of deploy more out of the available liquidity, as the asset stabilizes, the quality of the books, the slippages stabilize. Where are we likely to sort of stabilize on the yield? That's the first question. And second question is slide 24, right, Para. If I look at the retail assets part 30 plus, that's been inching up over the last 4 quarters. So while the trend on the IF book is encouraging, but on the retail assets, we see an increasing trend of part 30 plus. Is something to be read there? These are 2 questions.
Yeah. So I'll answer your first question. See, on steady state, so our GNPA currently is nearly 6%, and which is at a yield of 25%. So that 6% of 25% is nearly 1.5%. So if you technically do a write-off when we get the CGFMU money, if I do a write-off, technically my yield should go up by at least 1.5%. But however, on a steady state basis, if I have to maintain a mix of whatever we have guided, 45% unsecured and 55% retail, 45% should come at 25% and 55% should come at 12%. So theoretically, the yield should be in the range of 17 to 18. 17.5, you can take a steady state kind of a yield. So that's what you are asking is how much it would be reversed. 16.5 currently. At least technically it should go up by 100 basis to 150 basis point on an upper side. So 17.5 to 18 should be our steady state yield once we do a complete write-off and the business is as usual.
And on the retail assets of 30 plus, yes, there has been a marginal increase. As you know, commercial vehicle has been going through a little bit of a turbulence, so to say. There has been a marginal pickup in terms of 30 plus, probably because of the extended monsoons. And there has been a little slack and the deferment in terms of GST. Fairly confident, but we look at the overall portfolio of flow through from 30 to 60 plus has been moderated. In mortgages, yes, whenever there are 1 or 2 large accounts get into it, there is always an increase of that. But completely from a credit cost perspective, since their underlying assets are very robust and it is all cash flow based lending, either there is a resolution either in terms of customer coming back and rolling back in terms of current or in terms of disposal of the property. The disposal of the property is the last thing really we look at. Hopefully with that, we will not see the same trend going from 3.1 to 3.2 to 3.6 in the fourth quarter for sure.
Got it. Thank you very much.
Thank you.
Thank you. The next question is from the line of Ashlesh Sonje from Kotak Securities. Please go ahead.
Hi, team. Good morning. So a few questions from my side. Firstly, on the cost ratios, can you talk about how you think about the trajectory from here on? Let's say if I look at the cost income ratio, it is close to 75% today. How do you think about it going forward? That's all.
Yeah. So one of the important thing to highlight in our costs is that if you consider the corporate costs, right? So they have more or less remained fairly constant, especially in terms of the number of headcount that we have in our corporate workforce, right? So there will be an marginal benefit on the fact that from here on, as we grow our book, our corporate costs will not proportionately increase, right? The other is obviously the fact that, there was a drag in the denominator because of the non-paying book, and we have now been able to remove. So to that extent, you will see that there is a marginal improvement. We obviously hope to bring our costs to income ratios down in the second half of this year. At this particular point in time, from where we are today, being able to touch 70% along with the CGFMU costs that we have, that will be our first objective.
Understood. Okay. The second one is on the credit side. If I look at the increase in disbursements, I see that there is an increase across segments. Is this coming mainly because you see a much higher credit demand on the ground? How are the rejection rates trending? Can you share some insight on that?
So this is primarily our inclusive finance engine is growing quite robustly, and especially the Vikas loan segment, we have grown more than 100% year on year. And besides that, we also got quite robust growth in commercial vehicles as well as mortgage. So credit per se, demand per se is it's a very small size and scale to talk about any market share and industry level growth. So as far as we are concerned, there is enough and more opportunity to keep growing at a much faster rate. So that's not at all a challenge. And what was your second question? Sorry. Yeah. So
How are the
one of the
rejection
things.
rates trending? Yeah.
Okay. So on the rejection rate front, it has more or less stabilized. Earlier, it used to be as low as 27% in microfinance for the new customers. Now it is more or less trending to 35%, one-third of the customers are getting approved. So there is a little uptick, but in states like Karnataka and Tamil Nadu, it is still a challenge. So the more customers in the market are in par. So their approval rates are still in the range of 25-27%.
And sir, do you see a possibility to take further cuts in your savings or term deposit rates from here on?
So we keep evaluating it on a monthly basis. Right now, it's a very dynamic scenario. We try to, maximize our opportunity on that count. You would have noted that our MCLR is also coming down on a month-on-month basis, and our cost of deposits have also reduced, especially in July, August, and September. So we will continue evaluating that based on the kind of market demand that we foresee.
Understood. Thank you very much. Those are all the questions I had.
Yeah.
Thank you. The next question is from the line of Bhavik Shah from InCred Capital. Please go ahead.
Hey, hi. Thank you for the opportunity. So first question was regarding the written off pool. As in, what would be the quantum of written off pool and what would be the aging, and how comfortable are you to kind of at what percentage of recovery kind of do you see over the next couple of quarters from there?
So we have written off around 430 odd crores based on the CGFMU claim of 313 odd crores that we have received. Large part of it is, a book that was built in the last financial year. If we look at historically, we have been, making recoveries of around 6 to 7% in our write-off pool and around 15% in our NPL pool. Those trends will continue. We will try to improve it, especially with our focus on recovery from the recent NPA accounts in the second half of the year.
Understood. So just to clarify, so out of the 7% that we recover, 23% is what we keep and the balance goes to CGFMU, right?
Correct. Net of recovery expenses.
Understood. And I just wanted to check your comfort level on the PCR that we maintain on mortgages and lease portfolio, vehicle portfolio.
Given the kind of LTVs that we work at and the assets that we have in hand, we are comfortable with the PCR that we are maintaining at this particular point in time.
Understood, sir. Thank you. Thank you, sir. Thank you for the opportunity.
Yeah. Thank you.
Thank you. The next question is from the line of Rahul Kumar from Vaikara Fund. Please go ahead.
Yeah, hi. So how much were the MFI slippages in this quarter?
We had a slippage of around 206 crores in this quarter as against 267 crores in Q1. That is at the bank level. And if you look at MFI, we had slippages of 170 crores in Q2 versus 237 crores in Q1.
Okay. And I think you mentioned something about the flow of current flow which you are seeing in this MFI book. And what kind of recoveries do you see from the, the stage 2 or 30 to 90 DPD kind of a book? in the MFI segment?
Currently, I think what it used to be in the 1 to 30s was less than around 30%. Heartening to know that it has inched up to around closer to 40-45% in the 1 to 30. And thereafter, there is a dip in the 31 to 60. And the recovery in 60 to 90, which is what we call as PNP, and heavily the focus goes on resolving that, detaining it and rolling back, is currently hovering at around 30%.
Okay.
At the beginning of the month portfolio. If you look at from the middle of the previous month, then the resolution is around closer to 60%.
Okay. Okay. And yeah. No, and second question which I had was, would it be fair to say that our yields have actually remained flat during this quarter, and we have sort of seen the bottom in the NIMS portion?
Yes, that's correct. The yield also, had the drag effect of the non-paying book that we were carrying all this while. So from here on, that effect won't be there. So you will see the yields inching up. And like my colleague Himadri said a while ago, the theoretical impact of the non-paying book going away immediately is around 1.5%, and you will get to see that on a quarter-on-quarter basis for the MFI book.
Okay. Okay. So for overall bank level, where do you expect the NIMs to settle down, let's say, in over next 2 quarters?
We will be targeting around 8% from where we are today. That's what we have in mind at this particular point in time.
Okay. Okay. Thank you.
Yep.
Thank you. The next question is from the line of Pranat Shah from 3P Investment Manager. Please go ahead.
Hi. Thank you for taking my question. It was, again, on coming back to the Paytm partnership, you mentioned that you already have 50,000 accounts signed up on UPI and credit. So what would be the average sanction limit that you would have on these accounts?
This is about 12,000 rupees is the typical limit. So
sorry, how much?
1 minute. 53 crores, 50. Yeah, about 12,000 rupees is the average limit. It's the erstwhile postpaid program done through credit on UPI. So what we envisage is this is one segment which is completely serve the unpenetrated market of credit cards. Credit cards is grossly underpenetrated in our country. So this is one product that should scale, that should have a much deeper penetration to the wider segments of the country.
It comes to 10,000. 50,000 customers, 50 crores of sanction limit. Utilization is sub 15% to start with. Apparently, there is a pickup which happens over a period of time and settles down around 25. Good thing is that you test the rate of the customer, and most of them utilize sub 15%, 20%. Though the limit itself is very small, on average it's 10,000, but it's anywhere between around 10,000 to or little less than 10,000 all the way up till 60,000 max.
Understood. So just to get a sense of this, because if I look at your disbursement breakdown in the others category, which is where I think this is parked at, right now you are hitting at around 17 CR per quarter of disbursement. And even if I just take the sanction limit that you have over here and multiply it by 3, it comes to around 150 CR. So till where are you comfortable scaling the disbursements in this segment on a quarterly or a monthly run rate is where I would want to get at.
Let me clarify. Whatever we speak about disbursement is minus of the short-term revolving products, which includes supply chain financing. You don't mix that up because then it gives a very distorted picture in terms of the rotating portfolio, revolving portfolio, as well as on term loan portfolio. Mostly what we really speak about in disbursement is minus of these. Currently, which is a new product, 50,000, 50 crore limits, average of 10,000, utilizes only 6 crores. So even if it added, it is not, but currently the disbursement does not include these products at all. And we will not probably include it, and we will show it separately in terms of outstanding and turnover and all of that separately. Otherwise, a mix-up of in terms of a rotating revolving portfolio and a term loan portfolio may not give the picture.
The number is sanctioned, so obviously sanction cannot be equated with the loan disbursal. It's the utilization that matters.
Utilization is 6 crores at this point.
But is there any number of where you're comfortable to scale this up to, or you're not disclosing that at this point of time?
No, I don't think it's really kind of a scale beyond 100 crores. In terms of sanction itself, it will be probably a couple of months before it touches 100. The good thing about the product is that you are able to acquire high quality customers with a very small value of sanction and completely KYC done through the VKYC mode. So once you acquire the ability to then service multiple products completely digital because they come through the digital, and you get a good view of the track record because they pay the entire amount which is due at the end of the month. They don't carry it forward, they don't revolve it. So it looks like at this point of time our pilot is for around approximately 75 crores.
Understood. And fair to say that your revenue over here would be driven by interchange and late payment charges?
Not at all. Not so much on late. In fact, the good thing about the product is structured with a grace period of around 7 days after the billing date. There is no interest charge. It is on the convenience fee which is charged for every transaction and as well as in terms of the MDR. MDR is currently probably around 0.7%.
So 0.7% would be Suryoday's share.
It is a share between Paytm and Suryoday because the entire acquiring cost and servicing cost is borne by the partner at this point of time.
Okay. And would it be possible to disclose what the breakup of this MDR share is between you and Paytm?
No, we'll excuse others from this because it's a commercial contract between two parties, but it's quite profitable for us as a portfolio.
Understood. Thanks a lot. This was super helpful.
Thank you. The next question is from the line of Vidisha from CRK. Please go ahead.
Hello.
Ms. Vidisha?
Audible?
Yeah. Yes, ma'am. Please go ahead.
I wanted your guidance on the effect of rate cut on your margins and also your plans as to how you'll improve your GNPA.
So at this particular point in time, we do not foresee any further rate cuts. So that's unlikely to impact us. But if you look at our portfolio, our FIG book and our LAP book are the two businesses which are floating rate loans and are linked to the repo. So those are the two books that will have an impact if there were to be a rate cut from here on.
All right. And sir, how do you plan to reduce your GNPA and NNPA further?
So, like we said a while ago, our focus in the second quarter with the flow forwards in MFI having stabilized will be on recovering from the recent NPAs. So that will be a key driver of, reduction in the MFI NPAs. And there are a few accounts in LAP as well that we look forward to resolving in the current quarter in the second half of the year.
All right. Thank you, sir. That's it from my end.
Thank you.
Thank you. The next question is from the line of Slade Alexander from Artha India Ventures. Please go ahead.
Hi. So my first question is, with the capital adequacy ratio that you have, how much headroom do we have to keep disbursing capital without an additional fundraise? And secondly, I saw an announcement where the board would be considering a fundraise. What is the nature of that fundraise, and what would be the effect on ROE for current investors?
Yeah. So, a threshold for a small finance bank is 15%. So from where we have around a 7.5% headroom, right? And if you look at our risk weights, our risk-weighted book is around 75% of our nominal book, right? So that's the kind of headroom that we enjoy today. At this particular point in time, insofar as the capital raise is concerned, it's more an enabling provision. We will continue exploring options, but at this particular point in time, we are really not in need of capital, and there's nothing that we need to raise immediately.
Also, to add what Casey said, currently we have around 600 odd crores of GNPA, which is having a risk weight of 100%. Once we get a CGSME, we will write it off. So my capital adequacy will jump up by another 1.5%. So currently, whatever we have reported 23.54 is actually theoretically, if I write it off today, it is 25%. And next year, the profit will also add up. So we don't find a challenge to grow up to 15,000 kind of advances, which is maybe in Q2 or Q3 of FY27. We don't need theoretically any capital to grow. But yeah, we like I was also mentioning, we keep on getting options, we keep on meeting people. So that's a different story. But we theoretically we don't need any capital to do 15,000 crore, which is in Q2 of FY27 or something.
All right. And I think that's it from my end. Thanks.
Okay. Thank you.
Thank you. The next question is from the line of Ashlesh from Kotak Security. Please go ahead.
Hi, team. Thanks for the follow-up. Just one question. If I look at the NPA ratios in some of the non-MFI segments, especially home loans and micro mortgages, there seems to be a decent inch up over the past couple of quarters. Can you elaborate on what is the situation here?
See, there has been an inch up in terms of micro mortgages on account of the Karnataka. We have a sizable portfolio. We have a 500 crore or the 490 crore portfolio, closer to around 270, 300 crores is in Karnataka. So there was a pickup in GNPA. Good thing about the whole thing, at least in terms of micro mortgages, is that around 70% of the GNPA accounts are paying every month. They will continue to be in GNPA because they are not able to roll back fully. The momentum in terms of 70% of it is paying. So it's around technically adjusted for 2.1. Is around 1.1 is a non-paying book of micro mortgages. In terms of yields, there has been a certain inch up attributed to probably extended monsoons. Fairly confident that this is coming back on track. Measuring by the non-paying GNPA, the ratio is around just 30% in micro mortgages, around 50% in LAP. And LAP, HL, I don't have the numbers. And seeming fairly confident that it will bounce back.
On the mortgages side, the increase today, as of now, is visible more in slippages, or you see the collections on those NPAs being a bit weaker?
We have had a few slippages, which we are working to resolve. And we have initiated, legal proceedings under SURFACE as well. We hope to see resolutions in the second half of the year.
Okay. And the slippages would have now kind of peaked out, or is that still going up?
I think if you look at the LAP as a segment itself, technically while the credit losses may taper down to 0.5 or less than that, the GNPA even in a growing book usually kind of goes to around 1.5 to 2%. So our intent would be to can we really keep that out at sub 1.25, and which is where probably we'll give losses a little leeway, but not really beyond that.
Understood. Thank you very much.
Yep.
Thank you. The next question is from the line of Shailesh Kanani from Centrum Broking Limited. Please go ahead.
Good morning, everyone. Thanks for the opportunity and congratulations on good set of numbers. Sir, a couple of questions from my side. One is that the secured share in overall mix has been gaining momentum. Now, I understand we have had write-off as well in this quarter, so that would also have helped. But considering that we are already at 55-45 and there is some tailwind in MFI business, so are we recalibrating our mix guidance as such between secured and unsecured? That would be my first question. And my second question is on the yield front. What will be the yield on the JSG in individual lending book? And some of the lenders have peer sets have revised it on the upward side. So are there any plans on that front? These are my two questions.
Yeah, I think, yes, the mix is 45-55 today also because of the write-offs that we have taken. So from here on, there will be slight shift back towards MFI in the second half of the year, given the kind of, growth that we have in mind. Ideally, I think in the near to mid-term, we see ourselves being a 50-50 kind of a mix. And yes, on so far as the pricing is concerned, we are constantly evaluating it, and given the credit costs that we have had in the last 18 months, it's something that we will have to, recalibrate.
What we'll do, Shailesh, certainly for sure, is that even specifically since it is Vikas loan is where we're focusing, it will become risk-based pricing. So we're getting NTB VL not curated for long. There will be an increase in pricing. Equally, on a very good customers where our cost of collections is lower, where they're paying on their own, we'll also be considering a marginal reduction. So considering that the NTB VL will be a little higher share in the coming months, maybe there will be a certain bit of increase in pricing on that portfolio.
Yeah, fair enough. Casey, can you share the split of the write-off in terms of secured, unsecured?
Except for some 3 crores of write-off we have had for commercial vehicles, all of the write-off is towards MFI on account of backed by the credit CGFMU claim.
And similarly, if you can give a split of the gross slippages in terms of secured and unsecured.
Correct. So at the bank level, if you look at our slippages, we were at 206 crores versus 263 in Q1. Of that, if you look at the MFI book, we had slippages of 170 crores versus 237 crores in Q1.
That's helpful. Thanks a lot.
Yep.
Thank you. The next question is from the line of Deepak Agrawal from Param Capital. Please go ahead.
Good morning, sir. Am I audible?
Yes, Deepak.
Hello. Yeah.
Yes, please. We can hear you.
Yeah. So start with the first question. So say in the longer run, where do you want this unsecured percentage to settle down? Right? As we see banks, as they mature, obviously this unsecured book goes down. So maybe over the next 3-4 years, where do we see our unsecured percentage of the book?
Deepak, I think currently in terms of mix, we are comfortable with 50-50. However, as you would know, starting from FY23, when the asset quality did not really pose any challenge or was not likely to be posing any challenge, we went ahead and committed ourselves to CGFMU, and we also chose not to do any cherry picking of the portfolio in inclusive finance. All eligible portfolio we decided to cover ourselves under CGFMU. So currently we will continue to have a 50-50, but however, once the asset base in terms of both mortgages and commercial vehicle reach approximately say even 5,000 crores, even with the disbursements remaining the same as of the previous year, usually because given their long annuity products, the growth will be closer to 15-20%. The intent till such time we come and they become profitable, and we'll create a real robustness in terms of VL, individually assessing, individually collecting, so that we don't really run the risks of the group behavior in terms of crisis. We're looking at say FY26 at around 50-50, closer to that, a little shade higher probably for secure. Next year will be the same, maybe in a marginal 1 or 2% decrease. And in FY28 will be a real year of reset once these portfolios would have become substantial. And that point of time, ideally, it will be around 30-35% unsecured and around 65% secure. That would be probably a 3 to 5 year story.
Linked to this, so now if you look at the cost-income ratios, now I understand obviously of late the cost-income ratio looks high, but still even if on a steady state, if you look for us compared to more mature banks, so there is a very big gap we have to cover. So one is from here, do we expect at least in terms of the incremental growth of the balance sheet being much higher than the OPEX growth? Is it a fair way to look at it, sir?
Yes, Deepak. I think I'll ask Casey to get over to you.
Yeah, from here on at this particular point in time, like I said, I think there's a stability in the corporate costs that we have, and so there will be a marginal benefit in the cost to income ratio from here on, at least for the next 3 to 4 years, and that benefit will certainly flow through. While yes, if the mix improves more towards retail, there is likely to be a compression in our yields. But at the same time, the costs are certainly not expected to grow at the same rate as our book.
Right. And so over the next 2 to 3 years, as you mentioned, it will be more like 65% secure. So on a steady state ROA, ROE, if you have to look, So where do we land up, sir, in next 2 to 3 years?
So, I don't think we are looking at a 1/3, 2/3 split between, MFI and non-MFI. I think even beyond medium term, we would look at more like 40/60. And on that basis, I think our immediate goal will be to have a ROA target of at least 2% and with about, 7.5 times leverage.
So Deepak, we're also now investing in retail assets secured in terms of expansion, putting up branches, infrastructure. I think the steady run rate of either mortgages and this without further investment, we would look at this around closer to 70 crores. Our intent is to really take it closer to around 125 crores. So we'll be on an investment mode in retail assets till we reach around 125 crores, which is probably 6 months away max. At that point of time, there will be a tapering, the exponential, the incremental increase in terms of investments will not be more than the growth expected. That is when our operating costs for retail assets will drop down substantially and sharply. As of now, loaded for corporate costs, they're kind of marginal businesses in terms of profitability. But once that happens, that the cost tapers off and allocation becomes the same, then you will see a kicker on that.
And so just last thing from my side in terms of just an observation. So we have done extremely well in terms of securing 95% of the book, and in the toughest time for a lot of MFIs, and we have come out much stronger. Now from here, because clearly we are building the secured side on the mortgages and other vehicle finance and all. So just we want to see that with a growing balance sheet, whenever a adverse cycle comes in some of these products, we obviously are hit among the lowest in terms of the pain. So that I think would clearly stand out for us if we are able to.
Thank you, Deepak. Yes, indeed. In fact, we took the cover was FY23, and the slippages and all of that very, very marginal. It clearly kind of as a risk mitigant strategy rather than as a whether the claims will be higher than the premium paid. We kind of model that the claims may continue to be much lower than the premiums, but just in ever it were to happen, our capital will be intact. And obviously it was not even forecasted that it will be so quick. But yes, I think as a strategy we will continue having taken, and even when we took it was intended that we'll continue to cover ourselves in the unsecured, so that to an extent it becomes quasi-secured.
Thank you, sir.
Thank you.
Thank you. The next question is from the line of Somil Shah from Paris Investments. Please go ahead.
Hi, my question was asked previously, so no more questions. Thank you.
Thank you.
Somil Shah, please go ahead.
Ma'am, my question was already asked, so I have no further questions. Thank you.
The next question is from the line of Rahul Kumar from Vaikara Fund. Please go ahead.
Yeah, hi. Actually, just wanted to confirm a couple of data points which you had mentioned in the call before, but just wanted to reconfirm. So the MFI flows which are happening now monthly, is that figure close to 35 crores now?
No, so as I said, in MFI for Q2, our flow forwards were 170 crores. In Q1, it was 237 crores. In Q3, we expect flows to be around 35 crores per month, and in Q4, we are targeting about 25 crores per month.
Okay. And for the two buckets, 30 to 60 and 60 to 90, what are the kind of recovery rates which we are seeing?
As I mentioned earlier, 1 to 30 is a little higher. Currently moved up, I think it was very low. It moves up to around closer to 40%. In 31 to 60, there is a dip. And Shashi?
So 1 to 30, it has now gone up to 49%. So 31 to 60, 61 to 90, we are at 43, 44%.
Okay. Okay. I didn't get the 30 to 60 bucket data.
30 to 60.
40% is for 30 to 60.
Yeah.
Yeah.
Okay. And one question was, if I look at the collection efficiency for the IF book, I think excluding the last 12 month book, but I think the prior book is still 98.5%, right? Why is it still not improved much over the last, let's say, 3-4 months?
Actually, much lower, a little lower, because 98.6 is including the current book, which is at 99.5. While I don't have the exact split for the prior to 12 months book, likely that it will be around 97.8, 97.9. Don't have really a clear answer for that for two reasons. One, the customer has been current for all these months and taken a loan 12 months prior. Why is the slippage? I think it's kind of across the board. There is a couple of, even in every branch, there are a marginal number of customers drop cumulatively in 500 branches, 425 branches. The number goes to around 1%. So 1% moves out, and I think the challenge, what at least the good thing has been that once it moves into 1 to 30, earlier it was the recovery itself dropped down substantially. I don't have the exact numbers, but it was sub around 25. Now Shashi has mentioned, it's around closer to 45, 49%. So we'll let the challenge. Now the focus has to be in terms of rolling back the customer and staying put at that 1 to 30. So yes, there is, I think it is still a marginal stress which is left, and also could be the effectiveness of collection to pursue it on a continuous basis with the collections on other buckets also being focused on. Yes, the prior to 12 months book is little less than 98% as of now.
Okay. Is there any geographical concentration of this book which is causing us issues, or?
No, fortunately not much, except for Karnataka earlier and Tamil Nadu a little bit. And Gujarat has been one state which has been great for all along. It has not been a great run in the last 12 months, but looks like it has stabilized quite a bit, but not as quickly and rebounded as Karnataka did.
Okay. One question which I had on the non-MFI part. I think the provision coverage ratio over there is pretty low. Do we expect to increase it going forward?
Two reasons. One, I think it is a small value which you're talking about as at least for an overall basis, 30 crores. On an overall provisioning basis, if you look at it as net NPA after adjusting for potential claim, it's around 97%. So on a holistic basis, we are well covered. So segment to segment, if you look at it, yes, little shorter. But comfortable, and all the provisioning at least no lesser than the value of the assets that we have funded and available.
Mm-hmm. Okay.
Thank you.
Okay. Thank you.
Thank you. That was the last question for today. We have reached the end to the question and answer session. I would now like to hand the conference over to the management for closing remarks.
Thank you for taking time and joining the call. Thank you very much for your continued support. Thank you.
Thank you. On behalf of Suryoday Small Finance Bank Limited and Centrum Broking Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your line.